Are you tired of making emotional investment decisions that leave your portfolio in shambles? Discover the timeless wisdom of the intelligent investor and learn how to make informed and profitable investments for a secure financial future. In this video, we'll be summarizing one of the most important books in the world of finance and investing, The Intelligent Investor, by Benjamin Graham. This book, first published in 1949, has been widely regarded as the Bible of value investing and has inspired many successful investors like Warren Buffett. In this video, we'll be discussing the key concepts and principles outlined in this classic book and how you can apply them to your own investing journey. At the heart of Graham's approach to investing is the concept of value investing. Value investing is a strategy that focuses on buying stocks or other securities that are undervalued and selling those that are overvalued. This is an important concept outlined in The Intelligent Investor by Benjamin Graham. The goal of value investing is to maximize returns while minimizing risk. In the book, Graham provides examples of how value investing works in practice. For example, he explains that an investor might look for companies that are trading at a low price-to-earnings ratio compared to their industry peers. This indicates that the company's stock may be undervalued, and therefore a good opportunity for the investor to buy. The investor would then hold on to the stock, waiting for its value to be recognized by the market, and then sell it for a profit. Another example of value investing from the book is the concept of margin of safety. This is the idea that investors should never invest more money into a stock than they are willing to lose. In other words, they should always maintain a safety margin between the price they paid for the stock and its intrinsic value. This margin helps to protect the investor from potential losses in the event that the market or the company itself performs poorly. Graham stresses the importance of value investing as a means of maximizing returns while minimizing risk. By focusing on undervalued stocks, the investor can potentially earn higher returns over the long term while also reducing their exposure to risk. This makes value investing an important concept for any investor, regardless of their level of experience or the size of their portfolio. Benjamin Graham defines an intelligent investor as someone who has a well-thought-out, disciplined approach to investing. This individual takes the time to educate themselves about the market and to understand the risks and potential rewards of different investment strategies. They approach investing with a long-term mindset, focusing on the potential for growth over the course of many years, rather than trying to make quick profits. An intelligent investor is also someone who is able to separate their emotions from their investments. They understand that the stock market can be volatile and that prices may fluctuate rapidly in response to news or events. However, instead of getting caught up in the ups and downs of the market, they remain calm and focused on their long-term goals. In the book, Graham provides several examples of what an intelligent investor looks like in practice. For instance, he describes an intelligent investor as someone who is able to resist the urge to buy into hot stocks that are generating a lot of buzz, and instead focuses on finding undervalued stocks with strong potential for growth. This investor also understands the importance of diversification, and therefore builds a portfolio of stocks from different industries and sectors, reducing their overall risk. Another example of an intelligent investor from the book is someone who takes the time to understand the financial statements of the companies they are considering investing in. They know how to read and interpret balance sheets, income statements, and cash flow statements, and use this information to assess the financial health and stability of a company. An intelligent investor is someone who is well-informed, disciplined, and patient. They approach investing with a long-term mindset and are able to separate their emotions from their investments. By following these principles, an intelligent investor can potentially maximize their returns while minimizing their risk. Benjamin Graham introduces the concept of Mr. Market as a way to understand the stock market and the behavior of individual investors. Mr. Market is described as an imaginary partner who is willing to buy or sell shares of a particular stock at a given price. According to Graham, Mr. Market can be viewed as representing the emotions and opinions of the market as a whole. Mr. Market is depicted as being moody and erratic, and his prices can fluctuate greatly based on his moods. Sometimes he may offer a high price for a stock, only to suddenly drop the price the next day. Other times he may offer a low price for a stock that he later realizes is worth much more. Graham stresses that Mr. Market's moods and prices should not be taken too seriously, as they are often not reflective of the underlying value of a stock. An intelligent investor, according to Graham, should not be swayed by Mr. Market's moods. Instead, they should focus on the intrinsic value of a stock, which is the value of the underlying assets and earnings power of a company. By comparing the intrinsic value of a stock to its market price, An intelligent investor can determine whether a stock is undervalued or overvalued, and make investment decisions accordingly. In one example from the book, Graham uses Mr. Market to illustrate the importance of a long-term investment horizon. He notes that while Mr. Market may offer low prices for a stock one day, this may not necessarily be indicative of its true value. An intelligent investor who understands this may choose to buy the stock at a lower price, with the expectation that the stock's value will increase over time. In another example, Graham highlights the importance of having a margin of safety when investing. He notes that Mr. Market may sometimes be overly optimistic about a stock, leading to an overvaluation. An intelligent investor will take this into account and invest only when they have a sufficient margin of safety, ensuring that even if Mr. Market is wrong, their investment will still be protected. In conclusion, the concept of Mr. Market is a useful tool for understanding the behavior of the stock market and individual investors. By being aware of Mr. Market's moods and prices, an intelligent investor can avoid being swayed by emotions and focus instead on the intrinsic value of a stock, making investment decisions that align with their long-term goals. Benjamin Graham emphasizes the importance of diversification in investment portfolios. Diversification is the practice of spreading investment capital across a range of different assets and securities, in order to reduce the overall risk of the portfolio. Graham argues that this is a crucial aspect of intelligent investing, as it helps to reduce the impact of any individual investment that may perform poorly. One of the key examples from the book that highlights the importance of diversification is the concept of the well-diversified portfolio. Graham explains that a well-diversified portfolio should consist of a mix of different types of assets, including stocks, bonds, and other investments, with each investment having a different risk profile. This way, even if one type of investment performs poorly, the overall portfolio will still be protected. Another example from the book is the importance of geographic diversification. Graham notes that investing in a range of different geographic regions can help to reduce the overall risk of a portfolio, as different regions may perform differently in various economic conditions. For example, if the economy in one region is struggling, investments in another region may be performing well, helping to offset any losses. In addition to diversifying across different assets and regions, Graham also stresses the importance of diversifying within individual investments. For example, an intelligent investor may choose to invest in a range of different stocks, rather than putting all their money into one stock. This helps to reduce the risk of any one stock performing poorly and having a significant impact on the portfolio as a whole. Diversification is a critical aspect of intelligent investing, according to Benjamin Graham. By spreading investment capital across a range of different assets, regions, and individual investments, an intelligent investor can reduce the overall risk of their portfolio and increase their chances of long-term investment success. Benjamin Graham also explains the difference between growth stocks and value stocks, and why it is important for investors to understand this distinction. Growth stocks are stocks in companies that are growing at a faster pace than the overall market, and that have the potential for continued growth in the future. These companies often reinvest their earnings back into the business in order to drive further growth, rather than paying dividends to shareholders. Value stocks, on the other hand, are stocks in companies that are trading at a lower price relative to their earnings or assets, compared to the overall market. These companies may not have the same growth potential as growth stocks, but they are considered to be undervalued and may offer a higher return on investment in the long run. One example from the book that highlights the difference between growth and value stocks is the concept of the Nifty 50. The Nifty 50 were a group of blue-chip stocks that were considered to be the best growth stocks of the 1960s and 1970s. Many investors became overly optimistic about the growth prospects of these stocks, and began paying high prices for them. However, when the stock market eventually corrected, many of these stocks experienced significant declines in value, resulting in large losses for investors. Graham argues that the Nifty 50 episode demonstrates the dangers of investing solely in growth stocks, and the importance of considering value stocks in an investment portfolio. According to Graham, an intelligent investor should look for stocks that offer both growth potential and value, in order to balance their portfolio and reduce the risk of significant losses. The difference between growth and value stocks is a crucial aspect of intelligent investing, according to Benjamin Graham. By understanding the strengths and weaknesses of both types of stocks, an intelligent investor can make informed investment decisions and create a well-diversified portfolio that offers both growth potential and value. Benjamin Graham emphasizes the importance of the concept of margin of safety when making investment decisions. The margin of safety is a principle that involves buying securities at a price that is significantly lower than their intrinsic value. This provides a cushion for the investor in case the market does not perform as expected or if the underlying company experiences unexpected difficulties. For example, if a company's intrinsic value is estimated to be $100 per share, an intelligent investor may only purchase the stock if it is trading at a price of $70 or less. This provides a margin of safety of 30%, which helps to reduce the risk of significant losses in the event that the company's performance or the market as a whole experiences unexpected setbacks. According to Graham, the margin of safety is an essential part of the value investing approach, and helps to protect the investor against market volatility and unpredictable events. By considering the margin of safety in their investment decisions, an intelligent investor can make more informed decisions, reduce their risk of significant losses, and increase their chances of achieving long-term investment success. The margin of safety is a key principle in the approach to investing advocated by Benjamin Graham in The Intelligent Investor. By using this principle to make informed investment decisions, an intelligent investor can reduce the risk of significant losses, and increase their chances of achieving long-term investment success. Benjamin Graham highlights the importance of analyzing financial statements as part of the investment process. Financial statements are reports that provide information about a company's financial performance, including its income, expenses, assets, liabilities, and cash flow. By analyzing financial statements, an intelligent investor can gain a deeper understanding of a company's financial health and performance, and make more informed investment decisions. For example, the balance sheet provides information about a company's assets, liabilities, and shareholder equity, which can help the investor to understand the company's overall financial strength. The income statement, on the other hand, provides information about a company's revenue, expenses, and net income, which can help the investor to assess the company's profitability and growth potential. Additionally, the statement of cash flows provides information about the company's inflows and outflows of cash, which can help the investor to understand the company's ability to generate cash and pay its obligations. The analysis of financial statements is an important aspect of the investment process, and is essential for an intelligent investor. By carefully reviewing financial statements, an investor can gain a deeper understanding of a company's financial health and performance, and make more informed investment decisions. The book also emphasizes the importance of being a patient investor. The patient investor is someone who is willing to wait for the right opportunities and is not swayed by short-term market fluctuations or the opinions of others. For example, the patient investor is willing to invest in stocks that may not show immediate growth, but have long-term potential for growth and stability. They are also willing to hold onto these stocks for an extended period of time, even if the market experiences short-term dips, as they have confidence in their investment and the long-term potential for growth. Additionally, the patient investor is not swayed by the opinions of others, and instead relies on their own research and analysis to make investment decisions. They are not swayed by market rumors or popular opinion, as they understand that these factors can often lead to short-sighted and impulsive investment decisions. The patient investor is also willing to be contrarian and make investment decisions that may not be popular at the time, but have the potential for long-term success. For example, during a market downturn, the patient investor may choose to invest in undervalued stocks, knowing that the market will eventually recover and these stocks will likely see growth. Being a patient investor is a key aspect of being an intelligent investor. By being patient, relying on their own research and analysis, and not being swayed by short-term market fluctuations or the opinions of others, the patient investor can make informed investment decisions and realize long-term success. In conclusion, The Intelligent Investor, by Benjamin Graham is a classic and timeless book that provides valuable insights and strategies for investors of all levels. Through his clear and concise writing, Graham provides a comprehensive guide to value investing and offers practical advice for building a well-diversified and profitable investment portfolio. Whether you are a seasoned investor or just starting out, The Intelligent Investor is a must-read for anyone looking to build a successful and profitable investment portfolio. By following the principles outlined in The Intelligent Investor, an individual can become a more informed and confident investor. They can learn to make decisions based on value, not emotions, and build a well-diversified portfolio that can withstand market volatility and achieve long-term success. In today's ever-changing financial landscape, the principles outlined in The Intelligent Investor are more relevant than ever. By following these principles, an individual can secure their financial future and achieve their investment goals. Thank you for watching, and I hope this video has provided you with a better understanding of the principles outlined in The Intelligent Investor. Stay tuned for more videos on finance and investing, and as always, happy investing.